Hi everyone, I wanted to give a really quick update just because obviously there's so much happening and I get a lot of information, data, files, emails. This one from Goldman Sachs. As you'll know from the webinars of mine that you've seen and from my apprentices who are either on pipspredator.com or on my share investing software and course and program, you'll know that I've talked often about a double dip, that we're going to go lower in all probability beyond the most recent falls. Well, this is obviously what Goldman's are telling their clients and their wealthiest clients, that it has, the S&P has bounced back the kind of returns we've seen in the past. And what they're actually saying is, we could be at 0.1 on here. And we should not think that we're going to get a simple V-shaped return. So I wanted to share that with you, but that's not all. I've got about 13 more slides I want to quickly run through with you in this big update. First of all, Exhibit 1 again from Goldman Sachs Investment Research. S&P 500 performance after 20% decline since 1980. You can see what tends to happen after the initial decline. We're not talking a straight V-shape. And of course, 2008 could be a bit of an outlier. But as you can see, that even after 6 months, it is pretty unusual. It is pretty unusual. Let me just draw that for you. It is pretty unusual after such a decline for the market to then be up after 6 months. Months after a 20% decline, is it up? Very rare for it to be up after such declines. And the reason is, whilst you might get this big move upwards again, as we have seen, it's rare over that time frame then to be up. Okay, so what that means is that for those who are my pipspredator.com apprentices who are trading, you're fine. You got nothing to worry about because we're not beholden to buy and hold over 6 months. Those of you who are my share and investment ones, we've got the opportunity to pick up some good stocks, which we've got to make sure, whilst they've fallen sharply, that if the market is going to go up and ends up like 1998 or 2001, those stocks give us a good enough return. And should it not, that they're still good quality and we're protected and we have a strategy to buy into those slowly and gradually. So even if the price falls back, it's fine. We don't mind buying some more at a lower price later on because that's the strategy. But that's not all. Let's look at some more slides here. Okay, which equities do well during these periods of market volatility? So the investment picks, for those of you who are my investment students, that I'm going to give you are going to be very much centered on the kinds of equities which tend, or sectors which tend to do well during such period. So I'll make sure you've got these. Okay, and because this is investment related, I've put these slides on the share investment program for you, which is alpeshpatel.com/shares. Okay, so this, and actually there's about 60 other slides that I've put on there for the investment students. Okay, countertrend rallies, like I've said, are commonplace, and you can see a whole bunch of these happening time and time again. The largest counter-trend rally that has happened in these various periods. We've seen even 24% and so on and so forth. The point with counter-trend is goes up a bit, then it falls. So I'm just being strategic. If I'm trading as I do using pipspredator.com, it's not an issue. None of these things are anything to worry about because we're just trading. We're going to take the upward moves, we're going to take the downward moves. It's been a fantastic time to trade. But if we're investing, we've got to have a strategy whereby if we've bought, like I've bought some Johnson & Johnson, okay? Right, if it falls back, that's fine. I'll buy some more. I'm not going to spend all my powder on just buying it and trying to time the bottom. I'm not trying to time the bottom. I'm not saying there's bound to be a bottom. What I'm saying is because there might be, whilst I'll buy some now, I will, if it falls, buy some more later. Got it? We're not trying to time market bottoms. Let's be absolutely clear. And we're not saying for certainty there will be a bottom. That's where people go wrong. Stocks anticipate economic recoveries. I really wanted to share this one with you. Look at it in your own time. And what it's saying is that the market low tends to come before the end of a recession. Are we going to get a recession? Recession is 2 quarters of negative GDP growth. Come on. We're all sitting at home. Of course we're going to get a bloody recession. The only ones not getting a recession are those using my courses to invest and trade on the markets, obviously. Okay, how long does a typical recession last? Well, hopefully, look, I wish I had a magic wand and I could take off my trading and investing hat and say there will be no recession. Everything will be fine and go back to normal. But you can see the typical periods that I've put here. Like I said, these slides, because they're investment related, they'll be on my on the investment program, which is alpeshpatel.com/shares. Okay, it's not trading related, it's investment related, so for longer term purchases. Stairs up, elevator down. Sell-offs occur much quicker than getting back up to the peak. In other words, the short side of the market is never it is a lot quicker. The point here being, how long does it take? So what the point I'm trying to make here is, we've hit a bottom, haven't we? One bottom, might not be the only bottom, but we've hit it. The rise back, to climbing back, for those who think, oh, it'll happen just as quickly, we'll be back to where we were 3 months ago. No, you'll know from my webinars, when I've picked stocks for you guys, I've said, look, if I can get the return that we've just lost in 3 months, if I can get it back in a year, I'll be happy. Why? Because if in 3 months something's fallen 50%, I buy into it and it goes back to where it was 3 months ago, that's 100% return. From 50 to 100, that's 100% return. If that takes me a year, great, I made 100% return in a year. If it takes me 2 years, great, I've made 100% return in 2 years. Do you see what I mean? So I'm not saying it's going to come back as quickly, and this is some of the hard data which suggests why a 3-month loss doesn't come back even in 6 months. Got it? I'm told, I'm not a specialist on precious metals or mining stocks. It's not what I look at. Got it? It's not my specialty. However, I will share data with you when I've got it. These are the exchange traded funds or ETFs, index trackers basically, in precious metals. You've got the gold spider, you've got the gold miners, so on and so forth. You can see their epic codes. They're there on screen as well. In case you can't, here it is. Okay, those are the codes. That's not my specialty. However, I am told at these times that these should do well. If you're into those, it's up to you. They should do well, apparently. The Dow has recently fallen 37.1% from its February high. What next? What tends to happen next? Well, bear markets that begin in such periods when the Dow, it takes this many days, you can see there, days before it goes back, right? So what are the days? Average 137 days. What does that mean? Well, days until the end of the bear market would mean August. 137 days since February will be August. Sorry, there's a lot of information I'm throwing at you. I'm just giving you the end results and where the source of data is from. Now, here's another one. Scenarios. This is from McKinsey, the management consultants. Scenarios for economic impact of the COVID crisis. Now, you might love this because people talk about V-shape, U-shape, W-shape, recession. What's going to happen? I'm not going to read every single thing there. You can see, as you'd expect from management consultants, they've looked at the effectiveness of public health response, virus spread, and public health response. They've also looked at government economic policy. So you might say, well, actually, you know what? I think most people are keeping up to what the government's telling us in terms of public health, so it's pretty good. And the government economic response in my economy, let's say the UK, is, I think it's been pretty strong, you might say, in which case you would expect that we're going to be up here. Equally, you might say, well, I think it's pretty middle, in which case this is where we'll be. Now, you can take your time, you can look at this. I'm going to research it some more and come back to you with what I think's happening. I think we're somewhere between A4 and A1. I think we're somewhere here, okay? I think it's going to be somewhere around those kind of markers, right? You can pick your own, but I'm saying that's what I think is going to happen, right? I want to just give you another index tracker, quality. What our research shows is that quality-based index trackers, so index trackers which have a basket of quality stocks, tend to perform better in these kind of economic circumstances, right? And this is the index tracker qual. That's what it's called, right? What's it made up of? They tend to do better. This is lower risk investing because it's an index tracker and it's got quality stocks. What's it made up? Well, you can already see top 10 holdings by weight of it's made up of these kind of companies. You can sort of see why it's lower risk. You might say, me, Alpesh, don't give me bloody lower risk. I want high risk. I want to blow my head off. If you're looking for lower risk, that index tracker is good. You might say, well, forget the index tracker. I only want the best. I want you to x-ray into it, Alpesh. Show me the ones which are performing the best. Well, IT stocks tend to do better. high growth. That's one of the reasons why. Microsoft, Apple, you already know that I've mentioned the hell out of these. Okay, so there you go. And this is the stocks that Quality Index Tracker holds, which have contributed the most to its performance. Well, again, Microsoft and Apple are right up there. MasterCard, PepsiCo. Now, you might say, well, forget you, Alpesh. MasterCard are taking a right whacking. Yes, they are, but the market looks ahead. It looks ahead. So I want you to look at that. And then finally, market annual returns, distribution of S&P 500 returns since 1926. One of the reasons I have a triple leverage S&P index tracker, or ETF. Okay, and you can buy it like a share, an index tracker. Triple leverage is this. Most of the time, these things come around, all right? And I want to hold it from now until whenever. So if the S&P does generate a 20% return, I make 60%. If it doubles in value over the next 18 months, I make 300% in 18 months. There are risks. This is medium to high risk. Anybody not telling you that is not doing their duty. Because triple leverage index trackers, whilst they're index trackers of a big index like the S&P 500, and I'm holding it for the long term, because it's triple leverage, there's more risk associated than normal. Okay, I'll talk about that on alpeshpatel.com/shares. Okay, now again, if you're a trader on my pipspredator.com trading, you don't need to worry about this. The great news is you don't need to worry about the longer term, because you're going to trade the rises and falls and rises and falls. But I wanted to give this update to everybody, so I want to thank both groups of apprentices and students for being on board. I'll give more updates as soon as I can. It is a bank holiday. It's a bank holiday for me as well. So enjoy the rest of it. Stay safe, everyone. And wherever you are in the world, good luck to you all, and prayers for your family and friends as well. Thank you all very much.